this far. We're in the final batch of talks. So next up is going to be Jordi Munoz from Potion Protocol, and he's going to be talking about Potion Protocol, the next gen price insurance AMM based on the Kelly Criterion. So Jordi, the floor is yours.
Thank you so much, Connor. Thank you, everyone. My name is Jordi. It's a real pleasure to be here. I'm one of the founders of the Potion Protocol, together with Guillem Mosquera. He's right in the corner. And we also have in the audience some people from the Potion team. And we're really excited to be here to talk about the last 2 years of our history and our effort to trying to build risk management that everybody can enjoy. So this is what we're going to be covering today. We're going to start talking a new type of bonding curve that's based on information theory and that can be used to price derivatives. We're then going to be talking about the Kelly machine, which is the first Web3 native implementation of this new type of AMM. And then we're going to talk about Potion Unlock, which is how we actually released the intellectual property into a radically decentralized launch mechanic. So let's start with the bonding curves. And I want to start by talking about what was it that we were trying to accomplish? What was our original dream? And it was actually incredibly simple. We just wanted a smart contract that you could send your portfolio, your assets, and the smart contract would just hedge your position on your behalf automatically. So a really simple automated hedging machine. That was kind of our original dream. This was about 2 years ago, and Balancer, Uniswap were just kind of popping up in the market. And we were incredibly inspired by this new design, you know, the AMM, a type of smart contract that connects liquidity providers with users and has something that to us felt almost magical, you know, that the fact that it can make a price emerge directly from internal parameters, you know, without calling an oracle. That felt almost like science fiction, you know, it felt like magic. And the question we had was, can we actually apply that same design, but instead of having a bonding curve that can price swaps, have a bonding curve that can price derivatives, you know, risk applications like an insurance contract or a put option. And here the challenge was, how do we make the LPs not go bust? You know, if you want to have a market that's reliable for insurance, you kind of want to make sure that the insurer doesn't go bust, right? Because otherwise there is no market. And how do you protect the insurer, you know? So the insurer has one fundamental lever, and that is the premium. If I charge a super high premium, then the likelihood is I'm not going to go bust, right? But maybe I'm not also going to get customers. If I charge a very low premium, then probably I'll get a lot of customers, but maybe it's not going to be enough to offset the risk that I'm taking when I'm insuring other people. So the challenge here was, how can we find a premium that's kind of in between? You know, it's not too high, it's not too low, it's just enough for a transaction that is fair for both sides. The standard in the industry is Black-Scholes. It's been around for decades. And in some sense, Black-Scholes is very elegant and it's very simple. It's a one-parameter model. You know, you just give it the volatility and it will produce a price. But that simplicity, I think it's also its drawback. Black-Scholes makes really hard assumptions on the characteristics of the thing that you're trying to insure. And sometimes those assumptions happen to be wrong. And just to illustrate the limitations of Black-Scholes, here you have 3 underlying assets with identical volatility. And I think this highlights how Black-Scholes is completely blind to what's beyond that volatility. What's the mean of the distribution? Is this distribution fat-tailed? Is it a power law? You know, Black-Scholes doesn't know any of that. Black-Scholes just takes volatility. These 3 assets have the same volatility, and as you can see for the green one, the returns are amazingly good, and the drawdowns are kind of very acceptable. Chances are you're overpricing. Like, if the returns are so good and the drawdowns so bad, it means that the LP is probably charging too much. And in contrast, in the red dots, you see that in this instance, the LP is actually losing money. So he should have been charging a higher premium. So the net result is, if you're trying to protect crypto assets, Black-Scholes is just not going to cut it. You know, it's not well designed for that. So we had to look for something else. And we turned to something completely different, which is the Kelly Criterion, which is based on information theory. So John Kelly was working at Bell Labs with Claude Shannon. And obviously, Claude Shannon had a full theory of information. How can you transfer information without errors over a channel with noise? And Kelly took a different interpretation and tried to apply the discipline of information theory in the context of gambling and risk-taking. And I want to kind of save you a lot of the technicality and just try to land the basic intuition behind the Kelly criterion. And I actually want to ask a question. Imagine that somebody offers you a bet on a coin toss, and it's a biased coin toss. So this coin toss is 60% biased. So 6 out of 10 times, it's going to get the heads, and that's when you win. So can someone volunteer, like how much would you bet? If you have $100 and somebody asks you to bet 100 times, what percentage of your capital would you place on that bet, knowing that you have positive odds? You have 60% chance of winning. Anyone? I think you know too much, but like intuitively, like I don't know if anybody would say like 50%, 60%. What is a normal that would kind of naturally make sense? No takers? Okay, 1%, okay. So Kelly answers that question. That's what Kelly answers you. What is the optimal amount of your available bankroll that you should put on the bet? And actually, that's exactly what you see on this chart on the left. This is a 60% coin toss. And what you see here is kind of what's your expected terminal capital after a lot of repeated betting. This is exactly the case for an LP who's selling insurance. You know, he's continuously selling, taking risk, right? So you want to maximize not the one-off result. You want to maximize what's my compounding rate when I'm taking the risk kind of dynamically. So you can see that the optimal is 20%. So that's kind of non-intuitive. You know, you're giving me a bet that has a positive expectation, and yet the mathematics says if you actually bet 60%, you're going to go bankrupt, right? And so that was really interesting because the Kelly criterion kind of links utilization or your bet size with the expected compounding growth rate. And that's something that it's interesting that it's not more well understood. It's really fundamental when taking risk. What matters most is actually not so much the distribution of returns, it's actually how much of your capital you put at risk. And if we move to the graphic on the right, what you have here is the introduction of premiums. So now it's also a coin toss, but now I'm adding the degree of freedom that I can actually charge a premium. And what you can see is that for different premiums, this hump is at different places. So it feels like there is some relationship between what's the optimal utilization and the premium. And that's exactly what we were looking for. We were looking for a relationship between the utilization of a pool of capital and the premium that one should charge. We were looking for that magical bonding curve, you know? And so here came our breakthrough idea, which was, what if we actually kind of created a new curve that was the combination of all these Kelly optimas? You know, I can brute force, just numerically calculate what is the expected CAGR for all of these premiums, for all of these utils, and then concentrate on these points here and create a bonding curve that's the combination of these. And that's when we had an incredible result that told us that we were on the right track. It turns out that when you actually put together these points, they come together very elegantly in a very simple mathematical function, x times the hyperbolic cosine of x, which was exactly what we wanted. Our fear was we're going to find a bonding curve, but we're going to have to store the bonding curve on chain, which is going to be a nightmare. What we wanted was something similar, like Uniswap's xy equals k. We just wanted a simple mathematical formula that could tell you premiums at all resolutions. And here it is. It just popped up. You know, we didn't derive this analytically. It just popped up from the numerical optimizations. And so, like I said, this for us felt like the moment of truth, like the moment where we felt that our journey was on the right track. We felt like in the same way that Uniswap pioneered xy equals k as the bonding curve that allows you to price swaps, we had found a way to price derivatives on the same AMM model. There's a lot more that I'd love to say about this, but we don't have a huge amount of time. But I just want to touch really briefly on some of the Monte Carlo simulations that we've done comparing Black-Scholes to the Kelly criterion. So here we have, I think, 200 different assets. Each asset has been backtested with, I think, 10,000 paths. But they're exactly the same paths. In blue, you're pricing them with Kelly. In red, you're pricing them with Black-Scholes. You can see how Black-Scholes doesn't know anything about the mean, only knows the volatility, doesn't know whether it's a fat tail or not. It just knows volatility. So even though it's pricing at perfect volatility, so we're really backtesting with perfect information Black-Scholes, it still goes to bankruptcy. Whereas Kelly is able to take the entire PDF, not just the variance, is able to take all the information and compute a premium that complies with this basic idea that you need to have an expectation of profitability. You don't have to take my word for it. We open sourced all of the code. There is a website called kelly.finance. You can go and run your own back tests, derive your own bonding curves, and get familiarized with this new way of pricing. But we're really excited about this. Let's now switch gears and talk about the Kelly machine, obviously named after John Kelly. This is an actual smart contract implementation of an AMM that uses these new type of bonding curves. So this is the basic architecture. You have the LP there. The LP locks liquidity into a contract. When a buyer comes, they will send premium to that contract. And then provided that that premium matches the bonding curve, then liquidity is going to be sent away into an open contract. This is a standard ERC20 put option made by Open that becomes the escrow, right? Now the liquidity is kind of stored here. So imagine that I want to hedge my BTC or hedge my Ethereum. I don't want to sell Ethereum because I'm like a long-term believer in Ethereum. And also when I sell, I have like a tax hit. All I want is to cover my position. I just want to hedge some of my Ethereum risk. So imagine that I want to avoid Ethereum going below 500, for example, right? So in this case, 500 USDC would actually be locked in this contract, which to me feels like a really cool insurance because I don't need to trust the counterparty. I can go on chain and I can see that the entire possible payoff is already blocked away for me. At expiry, the contract calls Chainlink, it gets the price, and then it's able to determine whether there is a payoff that goes to the buyer or it goes to the LP. So imagine that at expiry, the price of Ethereum is 750, so it's above 500, the buyer gets nothing. And the premium is, the LP is very happy because the LP charged the premium and didn't have to pay anything off because the option expired worthless. But vice versa, if at expiry the price of Ethereum was 200, then out of the 500 locked here, 300 would go to the buyer and the rest would go to the LP, who would not be so happy this time around. They would still have collected the premium, but they would have a loss on the principal. Let's double click into the LP contract. Fundamentally, it's not that different to Uniswap. So Uniswap has a pair of liquidity pairs, Ethereum, USDC, for example, and then it's able to figure out what's the price as a function of the ratio between those two assets. In here, there is also a ratio, but instead of between two pairs of assets, it's between what's utilized and what's not utilized. So imagine that I have $1,000 of total capital, and I'm at 20% utilization. That means that I've already locked $200 in escrow, so I'm 20% utilized. And then I get a new order, and somebody's asking me to lock, let's say, another $600. So they want to take me to 80% utilization. So the contract is going to go into the bonding curve. It's going to look at what's the premium that corresponds to 80%, and that's when it's going to demand that it gets paid. As simple as that. Yeah. The magic here being, it's not calling an oracle. You know, it's just using, just like Uniswap, an internal bonding curve that allows it to produce pricing with the beauty that these curves are produced in such a way that you have always a positive expectation of compounding growth rate. This is the UX. We're looking now at the buy side. So when you go and want to buy an option, these are the options that you have. You can either create a brand new option with a nice thing that you can actually choose your own strike, choose your own duration. So that's quite uncommon. Like in most other protocols, LPs actually have to create pools with specific parameters. And if you're looking for a certain combination that isn't there, you're out of luck. In the system, we're able to actually customize the option at minting time, or you can also just choose an existing option that was minted by somebody else. This is the LP side. LPs in our architecture have their own pools. So for a lot of other protocols, liquidity is kind of aggregated into a gigantic pool. In our model, each LP has their own pool. Each LP has their own utilization. Each LP has their own bonding curve and has complete control. They're not mixing their liquidity with anybody else. They're kind of in full control of that liquidity. So here you can choose which assets you want to insure from that pool, what's the strike, the duration, and so on.
You can even customize the bonding curve. So our approach to this was, there is an element of subjectivity. You know, when you supply the PDF to Kelly, you get to choose which PDF you're supplying. You can use historical, or you can make an assumption about what the PDF is going to be like moving forward. So we don't want to decide on behalf of the LP what the bonding curve should be. So we leave that freedom to the LP. We just leave the parameters for the hyperbolic cosine here. And as an LP, I can use Kelly as a reference, but I can choose to actually offset the bonding curve to make it higher so that, you know, my risk tolerance is satisfied. You can also, if you're not maybe super sophisticated or some of this stuff feels complex, you can also just copy some other LP. You can come here and look at other pools in the system and their P&Ls and their performance, and you can decide to actually just clone one of these pools. This was audited almost a year ago now by Consensus Diligence. It passed with flying colors. It was a pretty cool experience. And in short, you can think of the Kelly machine as the first true instantiation of Kelly bonding curves. We put a lot of effort into making these sexy and pleasant to use and accessible. And it's fully audited and ready to go. And now I just want to finish by talking about how we actually, as a team of researchers, release this into the world, which is no small feat. Releasing a derivatives trading platform comes with massive legal liabilities, and we spent a lot of energy to try to land this into the world without fear of going to jail. So that's how DeFi protocols traditionally finance themselves. They kind of come together into a multi-sig of sorts, and eventually they release a token. That's like the DAO token, or the governance token, the protocol token. And that token, for the most part, is sent to a contract of the DAO. So it's controlled by the DAO for liquidity mining, treasury, and whatnot. Some portion is given to investors, like private VCs, that more often than not have financed the team ahead of time, and that's how they recover their investment. And then some of the token actually goes back to the developers themselves. And then from that same multisig or a multisig that they control, they deploy the protocol, and in some instances they keep admin privileges. So they issue the token, they deploy the protocol, and then they admin the protocol. So that, it just makes it really difficult to talk to the regulator with a straight face and say, you know, this is a decentralized project. It's not me. You know, it's kind of, it belongs to the community. It's a non-starter. So in our minds, this model has problems. One of them is it really decentralized? If there are 5 people that have the rights to kind of lock down the protocol, is that really decentralization? The other one is, do we really want developers to be taking these massive legal risks? Is it good for DeFi that the developers need to face jail time? In our case, we found out that in Europe, the regulation is up to 15 million euro in fines and 3 years in prison if you operate an unregulated financial marketplace. So it's serious stuff, you know. It's no joke. And for all these reasons, we kind of felt it's not enough. You know, DeFi needs a new way to release IP into the world that doesn't have these problems. And we came up with this idea of aggressive decentralization. And a lot of other teams follow this other idea of progressive decentralization. And for us, progressive decentralization felt a little bit like progressive pregnancy. You know, like you're either pregnant or you're not pregnant. It's not like you're progressively becoming pregnant. Especially in the eyes of the regulator, you're either need a license or you don't need a license. And to us, it felt very clear, you do need a license. We spoke to the CNMV here in Spain. We also spoke to the regulator in Estonia. It was pretty clear that we did need it. And so in the eyes of aggressive decentralization, the team doesn't do everything. So in the other world, the team is doing everything. You know, it's kind of financing itself and it's deploying and doing all these stuffs. In this proposal that we made, we're actually just researchers that write software. Writing software is legally safe. You know, we've checked this, that nobody can put you in jail for writing software, or at least just yet. So that's a much safer environment. The fact that we don't get to deploy the stuff also makes it more community-centric. A community actually has to deploy the thing. So from the get-go, it's decentralized, it's not centralized. And above all, the liability is massively, dramatically reduced. So that's kind of the design principles. How did we do this? You know, how did we actually release the code to the world. So we actually did it through a game. And this game was based on the loot. This is a game that, the loot is an NFT game that's open-ended, that was launched something like a year ago now. There were NFTs that had certain words in them. And it was really interesting because these words were kind of generative, and some of the words were more rare than others. But fundamentally, the key idea was that it was up to the people to decide what game to play with the cards. And we thought there was like some elegant idea behind that, a little bit like with a deck of cards. You know, if you're playing poker and you organize an illegal tournament, they're not going to go after the card makers. They're going to go after the people that, you know, broke the law with the game. So that creates like a really interesting isolation between the card maker, the guy that makes the cards, versus the lawbreaker, the guy that uses the cards to do something potentially negative. And so what we did was we took all the IP that we built, the smart contracts, the front end, the analytics, the user documentation, all of that, and we stored it on IPFS. But we stored it encrypted with a really long password, incredibly long password. And then we took that password and we broke it into shards, you know, lots of shards. And then we released a series of NFTs, 10,000 NFTs, where each NFT had associated to it a piece of the puzzle, a piece of the password. And so at that point, it was almost like in superposition. In some sense, the code had been released, but in some sense, the code was not yet open. Something had to happen, which is that the community had to reach consensus. Everybody had to decide to reveal their password for the code to become open. And this, by the way, was something that you could do on-chain. We actually developed a Web3 application that allowed a participant to submit their NFT and be validated and be told whether the NFT actually had a segment of the password that was authentic or not. I'm happy to say that this already happened. So we already sold all these NFTs. We raised something like $12 million. The game was played, consensus was reached, and the protocol is now open source and in the hands of the community. And the cool thing about it, by the way, these are the NFTs. I'll say something about them in a moment. But the nice thing about this game is that you're just creating kind of the conditions for the community to emerge. We didn't issue any token, you know. We just sold these NFTs, and then the community themselves issued a token. They self-issued a token, yeah, which is, come again? 5 minutes, okay. So yeah, pretty cool. This is what the NFTs look like. We had an incredibly talented designer, and we gave him this super difficult task, which is how do you represent an insurance contract visually? And we came up with this thing. Like, there is a lot of symbology here. Each of these codes represents a bonding curve, the 4 parameters of the hyperbolic cosine. And we minted 10,000 different permutations of strike, duration, and assets, making this kind of the first dictionary of Kelly Criterion generated bonding curves. We had different rarities with different decryption power, redundancy. And the idea here was to create like a community that had different types of actors and kind of generate some fun and some interesting dynamics between them. But overall, what we were really concerned with was how can we actually exist as a research lab that does research and then transfers that research to the community so that they can produce public goods with it in such a way that is community-centric, you know, that it's not progressively into the community, but the community has the full control from the beginning. We always thought this whole Kelly Criterion stuff doesn't belong to us. This is mathematics, you know, it belongs to everybody. So it's not like we should kind of try to protect it for ourselves. It's compliant, it allows us to, you know, live our lives without fear, and it's sustainable, it allows us to raise money in a way that is normal. So what's next for us? I think our first effort was around solving the problem for the LP, creating an environment where the LP was protected. Now we're going to put the emphasis on the buy side. So now we want to build this automatic hedger where I put my Ethereum there, and then I know that my Ethereum is protected, and I can come back in 20 years, and it will just have been cycling on my behalf, which I think is kind of a really elegant. I want this for myself, you know, that it feels like a much needed thing. These are some of the guys that that helped the project move forward. We were incredibly privileged with the teams that supported us. Our timing was also very lucky. The whole thing started in DeFi summer, so there was a lot of interest. I think there is somebody from Lemnis Cap that I saw on the agenda. Hello, sir. Thank you for supporting us. And this was it, guys. So as a quick recap, we've done something quite special, we feel, in coming up with a new way to price derivatives with information theory. We've built actually a Web3 system that takes that knowledge and brings it into production, and we came up with a way to release that such that we didn't have the fear of kind of breaking our lives. And this was it. I hope it was interesting. If you have any questions, I'd love to take them. I don't know if there is a mic. Maybe you can just.
Yeah. No, mic.
Oh, you have a mic.
I'm not sure if you said this, but can you upgrade the code? If so, is there legal liability there?
So the protocol itself has the functionality that allows for it to be upgraded, but we don't have the keys. In fact, we haven't deployed the protocol. The protocol will be deployed directly by the community, and the community will decide who has that key if they decide to leave it available. If we had the key, then we would have the liability for sure.
Okay, so they don't have the key, but they have the ability to give the key?
They have the code, but they haven't deployed yet. Correct. And when they deploy it, they will have to set, is the upgradability turned on or off, and who controls that. And it could be the very multi-sig of the community, or they could decide to set up like a board or something. It will be their call, That's kind of beyond our remit.
Makes sense.
Yeah, completely, yeah. That's a massive challenge. So this is Ethereum compatible. So we expected Ethereum.
Any other questions? Does the constant function pricer, does that apply to typical derivatives as well, or?
Yeah, thank you for this question. One of the nice things about Kelly is that incredibly general. It's an incredibly, like you're trying to maximize a utility function, and you can use any payoff, so it can be calls, spreads, puts, any payoff function with any probability distribution. Incredibly more general than Black-Scholes, which is one distribution and two payoff functions.
I'm curious what the rationale is for you said that they're individual liquidity pools.
Yeah.
Isn't there more advantage to having aggregate pools?
Yeah, that's another really good question. So because our system is utilization driven, there were problems with sharing utilization, because I could potentially bring utilization very high and kind of manipulate the price and take advantage of that. So we felt it was much safer to let each LP control their own liquidity. What we had to resolve is how do you re-aggregate, because that liquidity is going to be in like thousands of small pools. From the perspective of the buyer, that is a mess, So we actually built a router that is able to, when you send an order, see which are the pools that are least utilized with the best curves, and it builds like a custom route. And so from the perspective of the buyer, it still behaves as a single pool, right? And so in some sense, you have the best of both worlds. You have the easy experience from the buy side, and then from the sell side, I can build my pool exactly how I want it, and I know that my liquidity is not going to be mixed with anybody else's.
I mean, there's probably some other upstream thing you could do where you could create another protocol to create larger aggregate pools.
Right. And we expect, I mean, here we went for maximum flexibility. Some people may actually remove that flexibility and kind of build an aggregator on top. So, yeah.
You said that you're making profit from the software releases. Is that NFTs every time, or how do you do that?
Yeah, that's another one. So our business model is kind of weird. Like, we've been trying to figure out how do we exist, And also, like, when you're trying to open bank accounts and stuff, it's just really difficult, trying to explain what we do. It's like they assume that you're a criminal immediately. So for us, it was important to be able to tell a story that it was simple for kind of Web 2 environments. And this maybe still a bit out there, but it was simpler. Like, I'm just selling an NFT. It's a simple revenue. It's not an investment. People are not buying a token. They're just getting an NFT. And so moving forward, we have kind of two routes. Either the DAO hires us, but now it's the DAO that is the sovereign. You know, we're just kind of collaborating for the DAO. Or we just launch some other new project and we do another NFT release and we kind of keep doing this. You know, we keep cycling. And I think kind of that's our dream. If we could do research all our lives and find a way to monetize it, that feels like a really cool thing to do.
Brilliant. Well, listen, I think we could all talk about Potion for a long time. I'm really interested to hear a lot more about it. But for now, we have to cut it off there. But thanks a million again, Jordi, for that talk.